Major funding for these programs is provided by grants from HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Bank of America, Murray Hill Properties, SJP Properties, Greenberg Traurig LLP. Additional funding is provided by grants from Antares Investment Partners, Arbor Realty Trust, Athena Group, BRT Realty Trust, Burden LLP, C.B. Richard Ellis, City Habitats, City Investment Fund, Cushman and Wakefield, Eastern Consolidated, Essex Capital Partners, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, Jackson Development Group, Meridian Capital Group, McSam Hotel Group, Newmark Knight Frank, Moynihan Organization, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sidney Fettner Associates, Stonehenge Partners, Studley, Sutphin Properties, the Wyckoff Organization, Extreme Construction and Deconstruction.
Hello, my name is Michael Stoller, host of the Stoller Report, Real Estate Trends in the Tri-State Region. What's going to happen in 2008? 2007 has been a great year in the investment sales. But who has this crystal ball? I don't have my Apple near me. Who has this crystal ball of where the investment outlook is for 2008? Where do we go? Today I've assembled 4 leaders who allegedly have crystal balls, or will tell me what's happening in the horizon. My guests include Robert Knakal, chairman of Massey Knakal Realty Services, David Newland, principal of Newmark Knight Frank, Scott Latham, executive vice president of Cushman and Wakefield, and last but not least, Woody Heller, executive managing director, Capital Transactions Group, Studley. I got it right?
You got it right.
I got 100%. So, since you were the scribe, you're the historian over here, Mr. Latham. You had your notes, you put away your notes before the show. How much was transacted in 2006? It was a record year in capital sales. Do you remember that number?
2006 was approximately $30 billion.
And how much has been transacted this year through November 30th?
$50 billion.
$50 billion. And going back a couple years ago, what was a normal year? Woody?
$10 billion. $10 billion was a good year a couple years ago.
So what's happening? I hear this rumors that there's a little difficulty in the capital markets. There's a turbulence over there. Adam Raboy, speaking at the NYU Capital Markets Seminar last week, said the market sucks. There's no money out there. It's, investment bankers are playing defense as opposed to offense. What's happening?
Well, I think an interesting point of view, Michael, is to consider that the $50 billion in sales, while that's an enormous number, is really indicative more so of the uptick in value that the market's experienced over the past few years and not an increase in the number of transactions. If you look, some of the billion-dollar-plus transactions that have occurred make that number skew somewhat. But if you look at what has happened so far in 2007, annualizing the first half of the year's transactions, the total turnover in the Manhattan market will be running at about 3.4% of the total stock of buildings. Now, that number is going to be off a little bit in the second half of the year, but we're still going to be running at about a 3.1% turnover rate for the year, which compares very favorably to 2006. So the number of properties selling is not going up, but the amount being spent on those properties that are selling is greatly appreciated over the last few years.
That's over the last few years, but what about over this year? At the beginning of the year, certain buildings traded. 450 traded for $1,600 a foot. The condominium interest at 660 Madison traded for about $1,530 a foot. The latest deals that I hear now, I mean, the one which is public knowledge that was released, that SL Green is buying 388, 390 Greenwich Street, is at what, $830 a foot, something like that?
$600 per square foot.
$600 a foot.
But that transaction, the pricing on that transaction is governed by the leaseback rate. So it was an engineered
that's not a
transaction.
Midtown building. I think $1,000 a foot is not realistic at that.
But there are buildings that, would have traded. We were talking before, 31 West 52nd Street, which is owned by Deutsche Bank and Reef, and Heinz has a small interest. That building 6 months ago would have traded for what? Any idea?
I would say close to $1,000 a foot.
So now it's trading for $850 a foot. So have we seen an adjustment so far this year? I mean, you have a couple of transactions in the hopper. What's
Sure. I mean, I think you're seeing adjustments, so I don't think it's any great surprise. I think the question is what's causing those adjustments and what does that mean looking forward? I think the factors that are causing the adjustment, obviously, is where we've talked about capital constraints in the capital market. We can talk a lot more about that. Most people are familiar with that issue. I think the other thing that's a big factor that we're seeing is the expectation of growth. When you were buying at a major office building at a 3 cap, you weren't doing that because you thought rents were staying flat. Now, so you have the opportunity to take your existing $60 rents in a Class A building to $150. That's an enormous uptick in income. But if you couple that with the expectation that $150 is going to $200, it's even better. So I think what you're seeing is that I think people are still believing that rents are going to hold, or at least hold to a certain extent. And I think banks are still willing to underwrite reasonably to that level, but I think the expectation of growth has largely been relaxed out of the market. And I think that's impacting pricing in addition to a change in the credit markets.
I agree with you partially, but I don't agree with you with regard to banks underwriting these thoughts of what the rents are going to be, because the rents are not keeping pace. Right now, you still see leases signed, but these leases have been negotiated 6 months ago. What's going to happen in the first quarter? You speak to your guy who runs the the tri-state region. He said leasing activity is down. And if I asked Barry, he would say the same thing. It's
Right. I mean,
In times of uncertainty, you see a general pullback in the leasing market as people look for clarity in the market before they execute transactions.
Right.
And I think that that's going on right now. Having said that, I think that this market is undersupplied with space. New demand is about 3.5 million square feet per year. 60s, 70s, and 80s per decade, you saw about 56.5 million square feet of space delivered each decade. In the last 2 decades, projecting through 2010, you'll see about 15.5 million square feet delivered, and over that same period of time, you had roughly 25 million feet of space come out of the market.
Space is one, but when Bear Stearns lays off 10% of their employees, and when other investment bankers lay off, and the financial companies don't really need as much space, somebody says, I'm not going to renew that lease, or I'm not. I mean, Frank Lively of WAFA said he's in the Seagram's building, and not Seagram's, 345 Park. He has a renewal. He said, a couple of months ago they were saying you're going to have to pay $170. Now, last week they said to him, maybe you'll pay $130. Now, $130 is still a nice rent, but there is a big difference. And some buildings that had been sold were sold under the contemplation that rents could always go up. And not everything, with the exception of for Norman Sterner believing that everything can only go higher, it can go down.
Well, it is interesting, though, if we look, none of us really has the good crystal ball. That's not what we get paid to do. We get paid to finish deals. But if we look behind us and everyone says, well, there was irresponsible underwriting by the lenders, and yet we look back at the rent growth, and the rent growth was there in Manhattan at 20% a year, past 2 years. So unless you wrote your model today with those kind of things, which you can't do, which are not supported by the lenders, you still have some room and you still have some cushion in your rent roll, and you still have, I'm not saying it's going to be a
But you
beautiful
know what,
market,
David,
but tenants can't time the market. They have a lease
David,
that comes up,
David,
and it's
you
got to
know,
be
the
addressed.
New York City market that Scotty just gave you a number, it's not $50 billion only offices. Bob, how much would you say was done in multifamily?
A pretty good percentage of that, probably at least 30 or 40%.
So, and that market, you know, I mean, Scott, you did a deal, a large, notable deal a couple of months ago. You did the property at 570 Park Avenue.
530 Park
530 Park Avenue. And, you know, great location. You know, I know we had been looking at it and other people were looking at it. You know, what are rents? You know, people, what's your thought about the rental market today in the city? In the boroughs in the city.
Rental market is fantastic, and I think the underlying fundamentals in the rental market is something that we all look to support these prices that we're getting. If you look at particularly the residential market with less than a 1% vacancy in the city, that is one of the strongest markets around, and constrained by rent regulation, where you don't have a normal free flow of vacancy, that further constrains the market. So we're seeing in new product today rents approaching $80, $90 a square foot, and more astonishingly, in walk-up properties in the West Village, in the Central Village, Lower East Side, we have clients getting over $100 a square foot for rents in walk-up buildings because the apartments are relatively small.
That's right. It's not really the rent. Somebody says, I want a studio, so they don't, you know, it's 320 square feet. It may be, you know, it's a different case over there. But if the lenders, and I will tell you, the lenders are not lending as much as they did on multifamily before. So the equity isn't there. I mean, you're involved with a transaction in Long Island City, which right now is a difficult time. Why is it harder today than it would have been 6 months ago?
Oh, I think there's a lot of factors, some of which are specific to that transaction. That particular transaction involves some rezoning, and so somebody moving into that position doesn't 100% yet know what they're going to end up with. And so there's uncertainty related to that, and uncertainty is not selling terribly well to the banks right now, in addition to all the other reasons. But I think going back to the discussion we're talking about on the office demand side, something has just happened which I think is sort of notable and worth mentioning, which is that, you know, the supply-demand equation is all about demand because, as we've said before, we have very little supply, and we've had abundant demand for many, many years in a row. This last quarter is the first time that we've had negative net absorption of any material amount. So we've had 1 million square feet quarter to date in this last quarter, and that's an interesting question because I think what we're seeing with, you know, fewer people making leasing decisions, yes, if you have a lease that comes up, as you said before, David, you have to make a decision. Right. But if you're looking into the future and trying to time the market, that's an elective decision, and my brokers tell me that that's not happening at the moment as it has been happening for a while. So yes, there is less happening on the elective side, and that may translate into less demand, and ultimately that's going to drive rents. So it's been stupendous, and rents have been incredibly high. So even if we have a little bit of a pullback, using your example of 170 to 170, 130 is a heck of a fall. So I'm not sure I buy that, but even if rents relax a little bit, they're still very strong, and I think are still supportive of a lot of the values we're seeing.
I mean, yes.
Just to jump in, the residential rental market is as good as it's been, right? Probably in terms of occupancy and rents. The commercial market is as good as it's been on those factors. The hotel market, also it is at top. The condo market at a top. So what's interesting is the lending market is horrific. And that disconnect is, look, 80% of what you do, or 70% you borrow, so that's a big cost.
The fundamentals,
but
it's
the
capital markets.
Right, but it's the fundamentals of the capital markets, because many of the lenders will tell you that they allowed the fundamentals to go away. They weren't underwriting correctly. I mean, Bob's office in Brooklyn, I think you had the largest sale, highest price in Sheepshead Bay for this property, the highest ever recorded in Sheepshead Bay. Just closed. Now, why did that happen? I'll give it that you were a good broker, but I'll give it another reason besides why it happened. Because the buyer, a REIT, is gearing themselves for urban development. And New York City has a lack of retail business. It's a major thing. And this was a great location. Now, in downtown Brooklyn, prices are going down. I don't know about you, but with 12 hotels within 6 blocks in downtown Brooklyn, not all of these are going to be done. I know we've been looking at deals. A guy came to me a week and a half ago, wants to build a hotel on 54th Street. He said, it's a good location. He says, right next to Broadway. I said, how much is it going to cost a room? He says, about $1 million. You know, if it costs you $1 million, you got to get $600 a night, and people are contemplating the increases. If you think the office rents, they're just compounding. As Richard Bourne said today in my class, he said, all I do is take my money, all the money I'm making, and say, please, tomorrow it's going to be better. But it's not going to be better in the hospitality industry. You know, you sold the plaza, a lot of things happen, but the hospitality market is difficult today.
Well, I don't
A lot
know
of
about
amateurs,
that, Michael.
yeah.
I'd like to challenge that from the perspective
That's
of...
why I'd like challenging.
Absolutely. I've challenged that from the perspective of, I think we had 44 million visitors come to New York this year. And if you look at how that trend is progressing, we're at a very, very interesting time globally from an economic point of view where you have economies expanding all over the globe. There are people making a ton of money all over. That money is relatively powerful compared with the dollar. The dollar is terribly devalued now. So you have a twofold effect of that. One is that it's very inexpensive for foreigners to come to New York and to occupy hotels and spend money. But it also is cost prohibitive for some Americans to travel outside the country. So you have a lot of domestic travelers coming to New York City. So with all of that tourism volume and the demand that's going on, the market seems to be cooking along very well. And if you look at different statistics, you hear that there are 12,000 new hotel rooms coming online.
21,000 to be exact.
It depends which report you read, but you have to also keep in mind that we lost 8,000 to 10,000 hotel rooms over the last 3 years. So the impact with a market of 70,000 to 80,000 hotel rooms total, it's not really that big a percentage.
It's the same as residential, which is chronically undersupplied in New York.
You know what?
Yeah.
Let's remember, when that foreign traveler comes to New York City, the same way they are Manhattan-centric, do you think they're going to go, there's a hotel site that came to me, originally they wanted financing, then said, could you buy it? It's, you know, it's at the Triangle in Long Island City. I don't know how many people, you know, I remember, Woody, we did a show a couple of years ago, and we were talking about Long Island City, how foreign investors look at it. It wasn't something over there. The suburban market, the hotels in that market have been able to get people because they wanted to save money. But if there's a blip or something like that, those hotels aren't going to do that well. I mean, it took 40 years before the first hotel was built in Brooklyn, in downtown Brooklyn. And now there are 14, Hotel Blue, this one, that one. I mean, I know you've been selling the sites, but you know.
There are a lot of people making mistakes. There are a lot of people that have a big mezzanine loan that made mistakes. And the interesting thing is condo development. In the past years, the way prices have run up, if you missed your timing, you did better. You got bailed out. The market just bailed you out. I don't think that happens anymore. I think people get caught, and I think there's some bad projects in downtown Brooklyn, in Williamsburg, in worse locations that are going to die.
Hey,
it's going to happen.
You're
But not all
selling
of them.
your company is selling a deal where the building is up, nothing else is there. It's in the middle of downtown Brooklyn, where there will be gentrification. There'll be Ratnaville, you know, there'll be a mall, but you know, somebody has to be a pioneer. I mean. And in the book, which I did read, you know, very nice book, beautiful pictures, you know, you said that rents in downtown Brooklyn should be about $65 to $70 a square foot. Now, I agree what you're saying, we need space, but those yuppies who are moving into the East Village, they want to be in the East Village. They don't really want to be on Schermerhorn and Hoyt Street in downtown Brooklyn. You know, Long Island City is a similar situation. What happens, and I mean, the ones who really aren't aware of this, what happens with land development? You know, we have all these construction cranes coming to the city now because everybody's looking to get that 421A. What's going to happen after the 421As go bye-bye?
Well, from the perspective of the 421A expiring and looking at projects today, anyone buying land today, even if I handed you the deed today, Michael, you couldn't get that project in the ground to qualify. So we've been out of the realm of qualifying for the 421A in terms of sales for about 3 or 4 months.
So what happens?
And it has not had any tangible effect on the market. Only in
it's interesting in that land price has been sticky because, right, we said the 421A should hurt land prices. Construction costs for years now have been running up, and it should have hit land prices, and they've been sticky. They've stayed up.
And
I don't
land,
know if it continues.
well,
but-
in tertiary locations, I would say land is off slightly. But you could make the argument that land is increasing in value even today in the most prime locations. I know, Scotty, you sold a site at an incredible price for the museum. And for sites like that that are really, really well located, prime sites, it seems like
People will
there's
still pay for it.
tremendous demand.
I mean, but that's prime. I mean, let's talk about Harlem. Right now, Harlem is still in a gentrification because people have been getting 15-year tax abatements on that. When that 15-year tax abatement, because when somebody's looking at their mortgage, they look at it this way. If they don't have the 15-year tax abatement, what's going to happen?
Well, theoretically, that should trickle down and reduce the amount they're willing to pay for the apartment. You know, people often ask, well, what's the effect of the 421A going away? You look at it simply in terms of the monthly payment that occupant has to pay to occupy that unit. And to the extent they have to come up with the money to pay that tax that's not abated, that reduces the amount they can pay in terms of a mortgage payment or a common charge,
I had a guest recently on the show who is doing a development, not a development, he bought a building on the Upper East Side. And it's a good building, and he said, on the building, I said, how are you doing? He says, I don't have any tax abatements. And I had to reduce my price from $1,200 a foot. It's a very nice building, maybe 15 years old, 20 years old, totally renovated. He said, because people are looking at no tax abatement to this. And he said, my investor and I, we thought we were going to get $1,200, we're taking $1,000. And that's what's happening today on the marketplace.
What's his break even?
His break even is probably $850. I mean, it's not that
there's
he's
an
lucky.
interesting thing. The East Side, in my experience, or from talking to some developers we know, has been a little quirky because you have co-ops and other established buildings that have very low operating costs and very low taxes, and so they get compared to new product. And Robert Levine said, "Look, downtown, I just tell people what the maintenance is going to be. I just tell them the carrying costs, and they pay it. And on the Upper East Side, they beat me up. It's just a different."
That's exactly correct. Robert will tell you that.
But I think as the market is changing, I think we're seeing a market which is making greater distinctions in quality, right? So at the Plaza, which Scott sold, and those units are going for $3,000 to $6,000 a foot for the best units, and at 15 Central Park West, where the units are going for $3,000 to $5,000 a foot, or even perhaps greater, I don't even know. Those are the most blessed projects. Those projects of the greatest quality and the best locations are still extremely strong because there's so few of them, and we're still dealing in an affluent environment. People can pay for it and will pay for what they want to get. I think the distinction we're seeing as the market relaxes somewhat across the board is that the secondary or tertiary projects, where maybe they didn't assemble the entire site they were intending, but they were racing to get into the market so they could catch it before it may have changed, those projects aren't going forward, and the ones that did aren't doing quite as well as they would have expected. But generally speaking, if you're asking a lot of the developers of projects that are underway with sales, I think volume's a little slower, but prices are not that bad.
And who's buying?
They're holding up.
You said in the last couple of weeks you've sold.
In the last 30 days, we've signed contracts or closed transactions that were signed within that 30-day period of time for $2.1 billion, 7 transactions, and of those 7 transactions, 5 of them are to foreign capital sources. There has been a surge of foreign interest in Manhattan real estate over the past 90 days, primarily coming from Eurozone buyers, but we've also seen increasing capital flows out of Russia and the Middle East. And with the price of oil at $100 a barrel, I think we can expect that we're going to see much more of that money flowing this way.
What have you been seeing in the multifamily market?
I agree. Well, in multifamily and in smaller product in general, we're not seeing quite that percentage of foreign buyers, but most of those transactions are being acquired by domestic buyers that have significant portfolios of properties. But what we are seeing is that the foreign appetite is coming mainly from the countries that are our biggest export destinations. If you look at the economy in general, the gross domestic product has been saved mainly by the amount of exports that we have that are created by the weak dollar. So our imports are down, our exports are up. But if you look at the countries that we're mainly exporting to, those are the countries where people are coming into New York from to buy real estate. And it's very interesting, that parallel.
So let's look at it this way. Now I have 5 minutes left on the show, and I really want to know where you see 2008 on investment outlook. Woody?
Okay. I think you have to start with where you think the debt market's going to be and work backward from there, because I think that dictates a lot of what's going to be happening. My sense is that I think when we came after Labor Day, I was expecting the debt markets would clear by the end of the fourth quarter, and we would start 08 afresh with new allocations of money to the banks, and without all the CMBS markets sort of clogging up the system. I was obviously wrong in that expectation, and I think that probably it's well into the second quarter before that occurs. So I think that volume is going to be off. I think that deals are going to take longer to complete, as we've seen on several of the large transactions that have occurred in the fourth quarter. But I think the market is still going to be active. I think there's still going to be offerings. And I think the perception is that the difficulty that we're going through is a transitional stage, and that even in the short, long term, meaning in a few quarters, the market is going to continue to be strong, and it'll be as successful as we've been in the past.
Scotty?
I think volumes are going to be way down, primarily as a result of what's going on in the debt markets. The debt markets are affecting the large transactions the most. Those help accumulate the greatest amount of volume, and I think as a result, volumes are going to be way off. Yet I think that pricing is going to hold up. We've seen it come down a little bit.
We've seen pricing come down a little bit.
Come down a little bit, especially for secondary and tertiary locations. But if you're in the central pocket and you have real quality, I think values will hold up nicely, because most people believe that the rent will continue to hold at the levels that we're at. You're not going to see 40% rent growth, which we experienced in Midtown, or 22% in the downtown market. That growth will moderate.
David?
I'm going to agree. I think the price adjustment has come to a certain extent already. The values are down, and I think things will normalize. Hopefully the CMBS market gets back in June sometime. You have portfolio lenders who will be in the market. Volume will be dramatically down.
Robert, the consummate optimist?
Well, I believe that in the multifamily market, prices are not down, although cap rates are up slightly. But on a price per square foot basis, prices are increasing and will continue to increase because of the run-up in rents. I think the most important thing to look for in 2008 is going to be to see how unemployment does. As unemployment goes, so will consumer confidence, consumer spending, and interest rates, which has a huge impact on our market. And while rates going down doesn't mean banks have to lend, it's more likely that they will. Spread should narrow, and I think we're going to have a good year in 08.
So I'm happy that it looks
It's not
like
going to start till June, though.
the cup is going to the cup is going to roll up. It's not all the way down. The cup, there's enough water in it. And I'd like to thank Bob Knakal, David Newland, Scott Latham, and last but not least, Woody Heller for being here. Next week, we're going to get we're going to get some owners and some leaders on their opinion of where they see 2008. Thank you. See you next week.
Major funding for these programs is provided by grants from HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Bank of America, Murray Hill Properties, SJP Properties, Greenberg Traurig LLP. Additional funding is provided by grants from Antares Investment Partners, Arbor Realty Trust, Athena Group, BRT Realty Trust, Burden LLP, C.B. Richard Ellis, City Habitats, City Investment Fund, Cushman and Wakefield, Eastern Consolidated, Essex Capital Partners, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, Jackson Development Group, Meridian Capital Group, McSam Hotel Group, Newmark Knight Frank, Moynihan Organization, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sidney Fettner Associates, Stonehenge Partners, Studley, Sutphin Properties, the Wyckoff Organization, Extreme Construction and Deconstruction.